Today we are going to continue our discussion from last week where we talk about the foreign exchange market. Let's see what happens if there is inflation in one country. So the first case is when the Canada's inflation rate is less than inflation rate in the foreign country. Foreign country could be anywhere. We are just comparing Canada to some other foreign country. So for instance, if the inflation rate increases in the foreign country, all other things equal. So that's our ceteris paribus assumption. Or if inflation in Canada decreases compared to before, right? Overall, the rate of inflation, prices are cheaper in Canada compared to the foreign currency relative to before. The average price of Canadian goods and services is relatively cheaper. What's going to happen? Well, make a chart. We have to look at two important things, exports and imports. What's going to happen to our exports if our goods are all of a sudden relatively cheaper? Are we going to sell more or less? We're going to export more. If we export more, it means more demand for our currency. They need Canadian dollars to buy our goods and services. But remember, the focus of foreign exchange is the foreign currency, not Canadian dollars. And more demand for Canadian dollars is the same as more supply of foreign currency. Because if they want to buy Canadian dollars, how are they going to buy it? They're going to buy it with their own currency. And if you do a graph, an increase would be a shift to the right. So that just tells you what to do with the graph. What's going to happen to our imports if our goods are relatively cheaper and their goods are more expensive? Our imports are going to go down. We're not going to buy from them because it's a ripoff, right? So it means that we have less demand for their currency because we don't need their goods and services. So in terms of the graph, you would have to shift the demand curve to the left. All right, so let's go to the graph. You should be able to handle these things with the graph, and the graph really makes your life simpler. All right, so we have our good old foreign exchange market, which is the market for the foreign currency. The E is the price of foreign currency. The Q is the quantity of foreign currency. We have the supply and demand for foreign currency. I have number one because we're going to shift the curve. So we start with an initial equilibrium. This is before the change, before the event. Once there is the inflation, we have to shift our curves. So the demand curve shifts to the left. So you draw a new demand curve to the left of the old one, and you're going to name it demand 2. This is the new demand curve. The supply is going to shift to the right, and you are going to call that supply 2. And you're going to get a new intersection at the intersection of the two new lines, and that's going to be your new equilibrium, E2. If you compare E1 and E2, there is clearly a decrease. What does it mean if the exchange rate goes down? Exchange rate is the price of foreign currency. So foreign currency becomes cheaper, which is the same as saying that the foreign currency depreciates and the Canadian dollar appreciates. There was some cool animation on that slide. You can watch it again. Pause here, write down everything, draw the graph, try to make a nice large diagram. If you have color, use color. Show exactly the same two shifts that you have in the diagram. Let's look at a second case where Canada's inflation rate is greater than the inflation rate in the foreign currency. So exactly the opposite of the first case. For instance, the inflation rate increases in Canada, all other things equal. Or the inflation rate in the other country decreases relative to before. What it means is that the average price of Canadian goods and services is relatively higher. All right? The way of doing this is exactly the same as before. So you will have to make a small chart for yourself where you compare our exports to our imports. What's going to happen to our exports? What's going to happen to our imports? What's going to happen to the demand and supply of foreign currency? You should be able to figure these out. So I'm not going to give it to you. This is your homework. You must be able to figure it out, and you must be able to do the graph after. So you're going to have two shifts of graphs, and you're going to get a new equilibrium. exchange rate. So you have to tell me which currency appreciates and which currency depreciates. If you're stuck, simply go back to the last slide. It's really the same dynamic. All right, so write this down, fill the question marks for yourselves, and do the two shifts in your graph. Case 3 is when Canada's inflation rate is the same as the inflation rate in the foreign country. Well, what really matters is the relative prices. If the relative prices are the same as before or are the same across the two countries, there's going to be no change in exports and imports. All right. So if both inflations rise by the same rate, or if both of them fall by the same rate, it's not going to make a difference. Okay. What matters is the relative prices. Okay. So you always have to compare one country to another. It's going to be no change in the exchange rate as a result. Case 4, if Canada's inflation rate is not equal to the inflation rate in the foreign country. Well, not equal means either less or more. So look at where it is higher, which means that this reduces to either case 1 or 2. Okay, if it's greater in Canada or if it's less in Canada. Okay, so these two cases really aren't that complicated as long as you understand the first two. But still write them down and focus on this idea of relative difference. Let's see what happens because of interest rates. So we're looking at the impact of interest rates on the exchange rate. And the first case is when the interest rates in Canada fall, all other things being equal. Okay, so relative to elsewhere, the interest rates in Canada are lower. The key thing here is we need to look at the incentives of domestic and foreign financial investors. What are they going to be attracted to? Interest rate is what the investors earn on their financial investments. So they're going to opt for higher interest because they are motivated by higher interest payments. In this case, the demand for foreign assets is going to increase because foreign assets pay them more interest compared to Canadian assets. Now, if they want to buy foreign assets, let's say foreign stocks and bonds, what are they going to need? What kind of currency do they need? They're going to need foreign currency, and that's going to be an outflow of funds from Canada, right? So if you do a graph for this, you would have the demand curve for foreign currency increasing and shifting to the right. So let's do that. You have the foreign exchange market. What you see right now on the screen is really the initial picture of any market. You have supply, demand, and one equilibrium. Then always there is some change that happens. In this case, there is an increase in demand. So you'll have to draw a new demand curve. It shifts to the right, and you get a new equilibrium E2 with a new exchange rate. All right, and you can see the exchange rate goes up, which means that the foreign currency appreciates, Canadian dollar depreciates. One important thing here is the idea of incentives. If you want to be a good economist, you must always be very conscious of incentives. Interest rates are an incentive to investors. Pause here, write down, and copy down the diagram. A second case is when the interest rates in Canada increase, all other things being equal. This is really exactly the opposite of the first. So you can guess it's going to be exactly the opposite diagram, exactly the opposite result. But the process is a little bit different, so you have to watch out here. The idea is that the demand for Canadian assets will increase because Canadian assets are more attractive to the investors. And that's going to result in inflow of funds to Canada. So there's an increase in demand for Canadian dollars. But here, this is again where the only place where it could get tricky here. You don't care about the Canadian dollar when you do the graphs. You need to look at the foreign currency. That's really the focus. So more demand for Canadian dollar is the same as more supply of foreign currency. All right, so convert everything to foreign currency before you do the graphs. All right. Then you do the graph. So you draw your good old supply and demand. And in this case, you'll have to shift the supply curve. All right, so I'll let you do that and determine what happens to the new equilibrium. So do a new curve, find your new equilibrium, find your E2, the exchange rate, and tell me whether it's an appreciation or depreciation, or which currency appreciates and which currency depreciates. So fill in the blanks for yourselves and do the graph for yourself. Case 3 is if the interest rates in other countries increase relative to Canada. All right, this is exactly the same as case 1 really, because what matters is this idea of relative. Okay, so relatively speaking, it's the same as case 1. Case 4 if the interest rates in other countries decrease relative to Canada, and this is exactly the same as case 2. All right, one thing here is this idea of relative, and another thing which is also important is all other things equal. That's the ceteris paribus assumption. If you have other events going on in the world, then that might interfere with your prediction. If you want to make a prediction, you have to assume that there's only one change at a time. Pause here, write down, and do the graph also. I think you're gonna like this topic, purchasing power parity. Basically what it says is that in the long run, the exchange rate between two countries reflects the relative price levels. A currency would have the same purchasing power whether in the home country or the foreign country. It's the same whether a currency is spent at home or abroad, right? So this is quite intuitive, it's very logical, but let's look at an example to see what it really means. Let's say you have a good, some item, or a basket of goods that costs 1,000 euros in Europe. If you take that good to Canada and you convert the 1,000 euros to Canadian dollars, then the Canadian dollar equivalent would be able to purchase that good in Canada, right? So in other words, it doesn't make a difference whether you spend that money in Europe or you spend the same money in Canada. The good will have the same equivalent price in Canada, okay, once you convert it. And this is theoretical, so it's excluding transaction and transportation costs, right? It is theoretical, but it's an important concept. So the logic behind it is fairly important and also very straightforward. So in the long run, we have this formula that the PPP stands for purchasing power parity. The exchange rate according to the purchasing power parity equals the prices in Canada over the prices in Europe. Or you can manipulate that, do a little bit of cross multiply to get this other formula. Both are useful, so write them down and box them. The P represents price level, which would be either the CPI or the GDP deflator. If you don't remember what is CPI, write it out. It's Consumer Price Index, right? And both CPI and GDP deflator are price levels. All right, these are average prices of everything. All right, so write these down. Here's an example to illustrate the purchasing power parity, and that's the Big Mac index. They actually do have this index. The magazine, The Economist, you might have heard of it. They have this index. So let's look at an example. Let's say the price of a Big Mac in Canada is 6 Canadian dollars, and in the States it's 2 US dollars, and the exchange rate is 1.5. And if you remember, with the exchange rate, you have to be careful about the units. The units are Canadian dollars compared to the foreign currency. So you need 1.5 Canadian dollars to obtain 1 US dollar. Now, suppose you have 6 Canadian dollars. What can you do with your 6 Canadian dollars? How many Big Macs can you buy? You can purchase 1 Big Mac in Canada, right? Or you can convert your Canadian dollars to US dollars. Yeah, here's where you have to be able to do some cross multiplication. So you really have to solve this formula. 1.5 Canadian dollars is equivalent to 1 US dollar. What is the equivalent of 6 Canadian dollars, right? If you guys don't know how to do cross multiplication, if you don't know how to deal with this, you need to review your math. All right, this is simple math that you must be able to do. By the way, this $1 in the denominator is implied. So when you look at this 1.5 here, it effectively means 1.5 over 1. That's always there. So basically you do cross multiply. The question mark or the x which you're looking for would be 6 times 1 over 1.5, and that would be 4 US dollars. Okay, so 6 Canadian dollars are equivalent to 4 US dollars. Now if you have 4 US dollars in the States, how many Big Macs can you buy? If the price is 2, you can buy 2 Big Macs. So effectively you can buy either 1 Big Mac in Canada or 2 Big Macs in the States. What's the result? The result is that demand for Big Mac in Canada is going to decrease and the demand for Big Mac in the States is going to increase because relatively it's cheaper in the States. So the price, whenever the demand, if the demand in the States goes up, the price of Big Mac in the States will go up. The price of Big Mac in Canada is going to go down because there's less demand. So for instance, you're going to get $4.5 for a Big Mac in Canada and $3 for a Big Mac in the States, which makes the exchange rate 1.5, the same as before. But this time the numbers would work out. All right. Or the other possibility is that the demand for US dollars will increase. So not the demand for Big Macs, but the demand for US dollars, which means that the US dollar is going to appreciate. So E goes up, which means Canadian dollar depreciates. Yeah. Remember this thing, this was a little bit tricky. If E is the price of US dollars. So if it goes up, it means the US dollar is appreciating. So for instance, you have the same prices as before, 6 Canadian dollars and 2 US dollars, but the exchange rate is different. And again, the numbers would work out. All right, the formula that you have in the last slide here, they would work out with both these scenarios. And most of the time, it's both of them. So both prices and the exchange rates are affected. So the moral of the story is that if the price of equal goods are not the same in the two countries, there's going to be incentive to purchase in the cheaper country. All right. Now, I know what you guys are thinking. You're like, hang on. This is ridiculous. No one's going to drive down to these states just to buy a stupid Big Mac. Well, yeah, that's right. Especially if you live further away from the border, the price of the gas is going to be more, and this is not realistic. But remember, this is just an example for illustration. Think of the principle. The principle is quite important. If you have different prices that don't correspond to the exchange rate for more important things, for cars, for manufacturing items, for machinery, for things that could cost hundreds or thousands of dollars, then this becomes an important thing, right? And again, the whole idea is the logic behind it. We are talking about the mobility, the free movement of funds and goods and services. And by the way, in our day and age, this should be even more important because the shipment costs and transportation costs and transactions and all of these things are reduced to a large extent. Things are a lot more mobile than before, right? So it should be even more realistic than before. Anyways, pause here and write down your notes. So if you remember, we had two major types of exchange rate policy. One of them was flexible exchange rate and one of them was fixed exchange rate. Yeah. So let's look at an example. Suppose a negative demand shock for Canadian lumber internationally. A very good example of this would be a housing market crash in the States, kind of like what happened in 2008. To make homes in the States, they need lumber, and Canada is a big exporter of lumber, right? So if that happens, there's going to be less demand for our lumber. Okay, which means that Canadian exports will go down, which means that our aggregate expenditure will go down, AE, and our aggregate demand is going to go down. All right, and the GDP is going to go down because of that. This is basically old stuff from intro. If you don't remember, you might want to do a little graph for yourself where you shifted the aggregate demand curve to the left. So our GDP is going to go down, basically. That's the short version of this story. lower demand for Canadian dollar because there's going to be lower demand for Canadian lumber, right? So there's going to be a surplus of Canadian dollar and the Canadian dollar depreciates. It's going to become a weaker currency. They don't need our currency becomes weak. That's quite logical, yeah? Again, you can do a graph for this and see what happens with respect to the foreign exchange market where you do US dollars compared to Canadian dollars. Now, here's where it gets interesting. We're going to look at a flexible exchange rate system. Now, what happens is that in a flexible exchange rate system, the central bank doesn't touch the exchange rate, right? It says, oh, our Canadian dollar is weak. Okay, fine, let it stay weak, right? Now, if the Canadian dollar stays weak, the exports of other industries will increase, right? Remember, if our dollar is weak, it's easier for other countries to buy from us. If it's easier for them to buy from us, they're going to buy more from us. It's effectively the same as cheaper prices, right? So that's the idea. Our currency is weak, so yeah, we lost some points on in the labor in the lumber industry, but in other industries, let's say in the car manufacturing industries or the airplane industry or electricity, maybe we can sell more. And that's going to offset the initial fall of exports and GDP because of the other industries gaining. So, wow, that's kind of cool. The idea is that it absorbs the shocks to the economy's output, which is GDP and employment. So we lose some jobs and some income because of lumber, but we're going to gain other jobs and other income because of other industries. All right, so this is an advantage of flexible exchange rate. It absorbs the shock. All right, so write this down. Building on the same example, we had this idea that there is less demand for Canadian lumber, which means that our currency is going to become weaker. So we're going to look at a case of fixed exchange rate. In a fixed exchange rate system, the central bank would want to restore the value of the Canadian dollar. All right, so they're like, oh no, the dollar is losing value. We have to do something. Well, what are they going to do? How on earth can the central bank make the dollar appreciate in value again? The idea is that they would have to create some artificial demand for the Canadian dollar or reduce the supply of Canadian dollar. Either way, right? Remember, the value of something goes up if there is either too much demand for it or not enough supply of it. And the central bank can do that because the central bank is our monetary authority. So if you remember from intro, we had this thing called the money market, we had the central bank, we had monetary policy. And the idea of the monetary policy is that the central bank can increase or decrease the amount of money in circulation, right? So they can do that. So the central bank starts buying more Canadian dollars and reduces the money supply, right? And by doing this, they can increase the value of the Canadian dollar back to its original amount. But what happens also as we go along the process is that the interest rates are going to go up, right? If there's less Canadian dollars available, it's harder to borrow, which increases the interest rate, right? So the cost of borrowing is higher. The borrowers are not going to be happy. There's going to be less spending by households and firms, right? Remember, firms borrow funds to put in their business, right? They want to start a new factory or whatever. Households also borrow funds, especially for major purchases, durable goods, for buying cars, for instance. Either way, if the interest rate is higher, their spending is going to go down. So consumption and investment go down, which means aggregate expenditure goes down even more because we already had a decrease in exports, and the AD goes down, and it's going to shift to the left. And because of that, the GDP is going to go down, right? So, which means there's going to be a loss of even more output and employment. So in the case of a fixed exchange rate system, it reinforces the external negative demand shock. So initially there was a loss of GDP, and then we have even more loss of GDP, right? So it's kind of like a domino effect, which kind of spreads around to the entire society, to all sectors. And that's the disadvantage of fixed exchange rate system. You're artificially keeping up the dollar, but you're getting another hit. So if you've heard of the second arrow, this is an example of a second arrow. Sometimes you are hit with an arrow and you're bleeding and you're in pain. Instead of taking out the arrow, you kind of hit yourself with the second arrow. That's really the kind of mess created by the central bank here. Anyways, write this down. Now let's see how a fixed exchange rate works on a graph. So suppose the central bank decides to fix the exchange rate above the equilibrium rate. Now let's pause here and remind ourselves that the exchange rate is the price of foreign currency. So if it's above, if it's a high value, it means that the domestic currency, the Canadian dollar, is weak. And the benefit of that is it's going to increase our exports. So that's desirable when we depend heavily on exports. So you can think of exporters lobbying at the central bank to raise the exchange rate, and then the central bank is like, okay, fine, I'll raise it. So imagine E2 above the equilibrium E1, right? And at E2, you're going to see that we are at a disequilibrium. So the level, the quantity demanded of foreign currency is less than the quantity supplied, right? So you should be able to figure these out. Simply draw a horizontal line at E2 and see the intersection of D and S, demand and supply. So the distance between QD and QS is simply a surplus, all right? So that's excess foreign currency. So at E2, there will be excess supply of foreign currency, and that's called a surplus. And whenever there is a surplus of anything, there will be downward pressure on the price. So the price would tend to fall, unless the central bank buys out the excess supply of foreign currency, which means that they would have to be selling Canadian dollars. So effectively, the central bank has to print a lot of Canadian dollar and sell it in exchange for foreign currency just to keep the exchange rate up. So demand is going to increase, and that's artificial demand created by the central bank. So graphically speaking, you would just take the demand curve and shift it to the right. Notice that when it comes to the graph, you should always think about the foreign currency, not Canadian dollar. So as you can see, we move to a new equilibrium E2, where the exchange rate is at the desired level of the central bank. The problem with this is that it could create inflation domestically if pursued consistently. The idea is that the central bank is printing a lot of money, and that could create inflation. So they're gonna be like, oh no, what have I done? Anyway, write this down and draw the graph. The opposite of the last case is when the central bank decides to fix the exchange rate below the equilibrium rate. Okay, so they want to keep the foreign currency cheap, which means that our domestic currency would be strong. And that's when we depend heavily on imports. So you can imagine importers going and protesting in front of the central bank to lower the exchange rate, and they're like, okay, fine, we're going to lower it. So imagine E2 lower than E1 and draw a solid line just to show that this is a target. And just think of this as a price. Whenever the price of anything goes down, the sellers will have less incentive to supply it. So the quantity supplied is going to be low, but the buyers are going to have incentive to buy it because it's fairly cheap. So it's really the same as the law of supply and demand as you've seen before. And you can see that there's a distance between them. So there is something missing. There is missing foreign currency. There's not enough of it. So at E2, which is lower than E1, there will be excess demand for foreign currency, and that's a shortage. And whenever there is a shortage of anything, there will be upward pressure on the price of it. Okay, in this case, the exchange rate. Unless the central bank sells its reserves of foreign currency, okay, by buying Canadian dollars. So this is the opposite here. The central bank has to create artificial demand for Canadian dollar, which means artificial supply of foreign currency. Again, when it comes to the graph, you should always think about the foreign currency. That's what you draw. So in this case, you would shift the supply curve to the right. Okay, so you get supply 2, and you can see that the exchange rate drops and you get a new equilibrium E2. The problem in this case is that the central bank has only a limited supply of foreign currency. They have only limited reserves, so they could run out. And you know what it means when you run out of something, yeah? Oh no. So write this down.